All right, so you've got an insurance quiz coming up, huh? Feeling like you're drowning in a sea of terms and concepts? Hey, don't worry about it. You are in exactly the right place. We are going to cut right through the noise and lock in on the core stuff you absolutely need to know to ace this thing. Let's dive in. So, before we get into all the nitty-gritty details, let's just zoom out for a second. What even is insurance when you really think about it? I mean, it's more than just a piece of paper or a bill you pay every month. At its very heart, it's a really clever solution to a problem that's as old as time. And that solution, that core idea, is called risk transfer. Think about it like this. Your house catching fire is a huge, scary, uncertain risk that could literally bankrupt you. But with insurance, you can transfer the financial weight of that risk over to a big company. And what do you give them in return? A small, predictable payment, your premium. That simple trade is the bedrock of the entire industry. Okay, so here's our game plan for this review session. We're going to tackle 4 key areas. We'll start with the absolute most important concept. Then we'll get into the different kinds of insurance companies, the people who work there, and finally, the rules that govern the whole shebang. So let's get into Section 1. All right, Section 1, the core concept. Seriously, if you get this one idea, everything else we talk about is going to make so much more sense. This is the foundation right here. And that big idea is captured in one very important word: indemnify. To indemnify someone just means to make them whole again. Now, this is crucial for your quiz. Insurance isn't a lottery ticket. It's not designed to make you rich. Its only job is to hit the rewind button and put you back in the same financial spot you were in a moment before the loss happened. Remember that word, indemnify. Okay, so if the goal is to make people whole, who are the companies actually doing it? That brings us to Section 2. We're going to look at how insurance companies are built, because their structure tells you a lot about who they're working for. Okay, I'd put a big star next to this slide in your notes, because this comparison is a classic quiz question. It's pretty straightforward. Stock companies are owned by stockholders. Their goal is profit for investors, so they issue what are called non-participating policies. No dividends for you. Mutual companies, on the other hand, are owned by the policyholders themselves. You are an owner. Because of that, they issue participating policies. If the company does well and has extra money, they can share that surplus with you as a dividend. It's basically like getting a little bit of your premium back. Now, beyond those big two, there are a few other specialized types you might see. Reciprocal insurers are kind of like a co-op, where all the members agree to insure each other. Fraternal benefit societies are nonprofits that offer insurance to members of a specific group. You've got risk retention groups, which let businesses in the same high-risk field, say a bunch of doctors, band together to insure themselves. And then you have reinsurers. These are the insurance companies for insurance companies. They're the backstop for truly massive, catastrophic events. Here's another set of vocab words that always seems to pop up on tests. Domicile. It's just a fancy word for where an insurer is based. It's super simple. If a company is based in your state and sells in your state, it's domestic. If it's based in another U.S. state but sells in yours, it's considered foreign. And if it's based in a completely different country, it's an alien insurer. Domestic, foreign, alien. Got? Okay, Section 3, we've talked about the big ideas and the types of companies. Now let's get personal and talk about the people who make this industry tick, from the folks selling the policies to the ones who pay the claims. You can think of any insurance company as having 4 main engines. You've got marketing and sales. Their job is to get people in the door. Then there's underwriting. They're the gatekeepers who decide who's an acceptable risk and who isn't. When something bad happens, the claims department is the one you call. And the actuarial department? Well, they're the brains of the whole operation, the math wizards who figure out how much to charge to make sure the company stays in business. So if we put some job titles to those roles, it looks like this. The actuary is the number cruncher who sets the rates. The underwriter looks at a specific application and says yes or no. The producer, that's a general term for agents and brokers, is the person on the street selling the policy. And the adjuster is the investigator who shows up after a claim to figure out how much the company should pay. Okay, everybody, lean in for a second. Put your phone down. I can almost guarantee you that the difference we're about to cover will be on your quiz. It's that fundamental. Ready? Here it is. Agent versus broker. It all boils down to one simple question. Who do they work for? An agent represents the insurance company, period. They're appointed by the insurer and have the power to bind coverage, which means they can make a promise on behalf of the company that you are covered. A broker, on the other hand, represents you, the customer. They aren't tied to any one company, and their job is to shop around for you. And, this is key, they cannot bind coverage. Only an agent can do that. All right, we are in the home stretch. Our last section is all about the rules of the road, regulation. Because we're dealing with people's financial security, this is one of the most tightly controlled industries on the planet. Let's see how it's all managed. The history of who's in charge is actually kind of a wild ride. It's like a game of regulatory ping pong. Way back in 1868, the Supreme Court said, hey, states, you handle this. Then, decades later, in 1944, they did a complete 180 and said, actually, scratch that, this is a federal thing. But then, get this, just 1 year later, Congress stepped in with the McCarran-Ferguson Act and basically said, you know what? The states were doing a fine job, and they handed the power right back. And that's largely where it stands today. Now, even though the states are the primary referees, the federal government still has some big rules that apply to everyone. The Fair Credit Reporting Act is all about protecting your privacy. The Fraud and False Statements Act is a big one that makes it a felony for certain people to work in the business. And more recently, the USA Patriot Act requires insurance companies to help fight things like money laundering. So you're probably wondering, with 50 different states making rules, how is it not total chaos? Well, that's where the NAIC comes in. Think of it as a club where all the state regulators get together to create model laws and try to keep things consistent. But, and this is a huge quiz point, the NAIC has no actual power. It's an influential group, for sure, but it can't force any state to do anything. And don't for a second think that these rules don't have teeth. If you break federal fraud laws in the insurance business, the penalties are incredibly steep. We're talking a fine of up to $50,000, on top of up to 15 years in prison and, of course, losing your license for good. They do not mess around. So when you pull it all together, it leaves you with this one big, fascinating question, doesn't it? Who is this whole system really designed to protect? Is it built for the policyholder, the person who needs to be made whole? Or is it built for the company, which needs to stay profitable? The truth is, it's a constant balancing act between those two things. And understanding that tension, well, that's what understanding insurance is all about. Keep that in mind, nail those core concepts we talked about, and you are going to do great. Good luck on your quiz.